Thank you very much for having me discuss this interesting paper about loans and bonds and how they're priced. I think this is an important question. This is just a picture showing this that happened to be lying around on my computer, saying that in many markets, loans and bonds are very large sources of financing for companies. Even though the US has a lot of bonds and less bank loans, this is just adding up in Capital IQ in 2010. Even though there's a lot of bonds and fewer bank loans, even in the US, bank loans are a big source of funding for large companies. All right, so this paper says the loans are expensive. I think that's the key takeaway here. You look at this nice graph, it's not obvious at first glance the loans are expensive because loans are the red line. The red line is below. Okay, so on average you pay less for a loan. Okay, so over here, these are firms that look distressed. Loans are a little more expensive than if you were safe. Bonds are a lot more expensive. Okay, this is okay. This is fine. The puzzle is over here, that they're the same. The reason this is a puzzle is that in default, the blue stuff is behind the red stuff. Okay, so the bank loans are first in line, they get paid first. So when there's a default, they should be doing better. Therefore, the red line should be below here as well. So this difference, that's fine. If you just look at the averages, the average loan in the sample is 279. The average bond is 372. These are spreads. Okay, the cross default, let's talk about that for a second. Okay, so when you default on one debt instrument, you're automatically in default of all the other debt instruments because of a clause in the debt contract, the cross default clause. This means that the event of default is identical. Therefore, the probability of default is identical. So the payoffs could be different. And loans are secured. That means they have a more senior claim in bankruptcy. That means they should be doing better conditional on default. So a model based on Merton 73 basically predicts that the spread should be about 108, the loan spread. So that's the green line, okay? So I can't replicate this exact picture here, but just look at the means here. So the bonds are here, the loans are cheaper, that's fine. They should be, but they should be even more cheaper. And so they should be all the way down to the green line. So the puzzle is, why are loans so expensive? That's what the paper is about. So loans and bonds are different in many ways. For example, security, that's the main point of this paper. They tend to differ in maturity. Ownership, are they callable or not? The form of interest, what kind of covenants do you have? What happens in restructuring? What kind of restructuring can you have? So to go through that quickly, bonds and loans conventionally differ in that bonds are unsecured and loans are often secured. Maturity tends to be longer in bonds. You can't get a term loan for 20 years, but you can issue a bond. You can issue a bond. Some firms can issue 100-year bonds. Ownership of a bond tends to be pretty dispersed. You have a lot of investors, whereas a traditional bank loan has only one owner, the bank who makes the loan, and even a syndicated loan only has a few. So you have a much more concentrated ownership for a loan. What about callability? About 2/3 of bonds issued in the US are callable. Maybe a little less if you're investment grade. I'm not as sure about loans. I know all leveraged loans are callable. There's a little window at the beginning. Leveraged loan means high yield, by the way. There's a window at the beginning of the life of the loan when you can't call it. After that, callable. I'm not so sure about investment grade, but these could be different. Bonds tend to be fixed, loans floating, covenants. Okay, so bond covenants, you only have to meet, they only apply, say you have a debt, EBITDA, debt ratio covenant for a bond, you only have to meet it if you're taking out new debt or doing some kind of transaction, whereas loans, you have to meet them all the time. So the covenants for loans are tougher. Even if the number is the same, the ratio you're looking at is the same, the loan thing you have to meet all the time, the bonds not all the time. And then restructuring, so because of the Trust Indenture Act of 1939, you can't really do anything to bonds outside of Chapter 11. But loans have that flexibility. Now, this is just the prototypical difference. Then you have a whole range. So you can think of high-yield bonds, high-yield loans, investment-grade loans, single-lender loans. On some of these dimensions, they're sort of spread out on a whole spectrum. So there's a continuum of different. So for example, single-lender loan, you have only one owner. Investment-grade bonds can have incredibly dispersed ownership. All right. So if there's a price difference, there are many places we could look. One observation of what we're looking for is that we're not looking for a reason that investors dislike loans. So think of an insurance company that says, yeah, bonds are liquid, I like them. Loans are illiquid, I dislike them. Therefore, I need more money, more return, higher interest to own the loan. That's not an equilibrium, okay? In that simple world, we'll all meet, all the insurance companies and all the corporate debt issuers will meet in the bond market because it's better. So we need something a little more complicated than saying, yeah, investors dislike giving loans to firms, right? Whether it be liquidity or whatever the terms. We need some kind of equilibrium thing, not just so that they coexist in the economy, but that individual firms are active in both markets. Here's an example of what happens, the importance of this out-of-court business. This is, again, something that happened to be lying around on my hard drive. This is based this is counting APR violations in Moody's default data. So in bankruptcy, comparing loans and bonds, APRs happen. They're not super common. They're about equally common for loans and bonds. Why does this happen? Well, once we show up in Chapter 11, we all get our own, every class gets their own lawyer paid for by the firm. The judge is there to make sure everything is by the book. We're following the rules. So whether it says this is a loan, this is a bond, it's not very important. Once you go out of court, APR violations for loans are basically unheard of. For bonds, they happen quite a lot. How does this happen? This is usually some kind of distressed debt exchange. So the bondholders are put in front of some take it or leave it offer, and if they don't take it, the ship will go down in flames. And so they take it, and so they lose money. So this is one example where maybe it matters to what you do, conditional on default, even though in bankruptcy settings, you would be treated the same. All right. One comment about the sample composition. I think there are revolvers in here. So revolvers have some kind of optionality. It's a credit card, right? It's not a mortgage. So you get $0 to begin with, and then you decide over time how much to draw. There's often grid pricing. I think there's grid pricing of other kinds of syndicated loans. It could look something like this. So here's a loan. Depending on your leverage ratio, is it below 1 or above 3? Your fees will be a little bit different, about 50 basis points. All right? I don't think that happens in bonds. So therefore, revolvers are a little different from bonds. Then there's the risk of cancellation. I have never quite figured out how this works, but recall this event. Let's see, here it is. This is from January 29, 2009. This is about when S&P 500 is bottoming out in the crisis. Ford drew a $10 billion revolving credit facility. It was undrawn. They drew all of it, and they specifically said at the time, we have no use for it. Okay? What were they worried about? I think they were worried that if they didn't draw it, it would go away. And I think there are a lot I've been staring at these contracts. I'm not enough of a lawyer to understand how it happens, but I think banks can basically pull that revolver if you haven't drawn it. So that's a big difference between a bond, which is obviously there, and a revolver, which apparently in some settings you risk it going away. And then the maturity, I don't know what the maturity really means of a term loan. So, sorry, of a revolver. So for these reasons, I would be more comfortable if the results just put revolvers to the side. The big sample is 16.5 minutes. It's kind of late, 5 seconds. So the big sample is 1682 loans. In the small sample that's used in the structured model is 199. The filter here is to take out revolvers and possibly some loans that are secured but with a second lien. And I think the revolvers feel very different. Maybe we should have just taken them out all along. If there are any second lien term loans, I'm also worried. A second lien term loan, that's like being unsecured. If you have a second lien, it means the first lien gets paid out of the security. Then when they're completely happy and have walked out the door, if there are any scraps left, you get those. That's very similar to being unsecured. Okay, I think if you go to S&P and Moody's and you look at the historical average recovery rates in bankruptcy, they're the same between unsecured and second liens. All right, so I think maybe narrowing the sample to begin with might be useful. Okay, this is a smaller point. This is the business cycle in the US. These green things are recessions. This is from 53 to 2013. This is just data from this is just aggregate data. The blue line, the dark blue line, is how fast is the stock of loans growing, corporate loans, and the light blue is the real growth rate of the stock of bonds. And what you see is whenever there's a recession, this dark blue thing really dips. That's because the bank loan stock really shrinks. That's because banks aren't making any loans in bad times. So when you're looking at firms that have both a loan and a bond, I think typically they will more often have issued the bonds in bad times. Right? Or think about the financial crisis. In 2009, the loan market really closes. The bond market slows down, the loan market really closes. So if there's a sample where you have firms that have both, they will more often have issued the bond. I think you might have to think about it. Well, most of it is taken care of by looking at the current pricing of the bonds, because once you've recovered, things are better. Okay. All right, so I think this is a good topic. If loans are worth more than bonds to firms, we want to know why and how much. So of all the list of features that would explain why they're better in some sense, we would like to understand which one is priced. That seems like a good question. There's sharp identification by narrowing the sample. As Mike says, the external validity is less clear. I think that's perfectly fine. All these firms who will never touch the bond market, obviously we can't answer this. We can't use this methodology for them. That's the way it is. On the other hand, what would the question even be? But I think dropping revolvers and possibly second lien loans, if they're lurking in the sample, might be more important than exact maturity matching. So if the sample is then too small, I might maybe be willing to, loosen up on that. Then there are many follow-up questions that I don't think are incumbent upon the author of this paper to answer, but I think they're out there for future research. And I think it would be useful to think also in terms of the great variety of institutional structures that are present now in the credit markets, so that in the leveraged loan market you have dozens of investors, whereas in the investment grade syndicated loan market you have maybe a dozen, and you used to have 5. And so there's on many dimensions this whole range, so it's not just black and white. Okay, great. Thanks.